Hello and welcome from Trend Signal for our review of the data and events the week beginning the 3rd of August. Overnight news, markets are a little bit subdued following some fairly poor news from China. Just a quick look at that. The final PMI data came in at 47.8 in July. Market consensus was for 48.3, so a lot weaker than expected. That figure's down from 49.4 in June and below the neutral 50 level. So anything below 50 signifies a contraction in the manufacturing sector, and that's the fifth successive month that we've seen a contraction in the manufacturing sector. And it's the sharpest deterioration in the health of the manufacturing sector since July 2013. Obviously, not good for Chinese economy, not good for commodities in general, and probably not very good for the Aussie dollar or the Canadian dollar for that matter. Okay, so first week of the new month in August, as we are, signifies the release of the non-farm payroll data, the employment data in the United States. That comes in on Friday, Friday the 7th at 1:30. It has added poignancy as the Federal Reserve continues to contemplate its first rate rise since 2008. As we know, expectations are that they could or may raise rates in September, so this data will be particularly important. Not that it isn't normally important anyway, but it has added importance this week. Apart from non-farm payroll, we also have three interest rate decisions from Australia, Japan, and the United Kingdom from our own Monetary Policy Committee on Thursday. August, holiday month, obviously. We're now first week of August, when a majority of key institutions or key individuals take a holiday. The volumes tend to decline by up to sort of 30%, but we can experience sudden bouts of volatility because we're not devoid of news. It's just that there isn't the volumes to absorb some of the news, so you can get some significant moves, so very much worth keeping focused on the markets. Month-end shenanigans last Friday pushed the dollar down into the European close and saw it recover over 150 points versus the euro by 8 p.m. The initial move was prompted by disappointing wage growth data released on Friday, which showed a rise of just plus 0.2%, the smallest quarterly wage rise in the US since 1982, which is alarming some people. That same news was responsible for a sharp rise in US treasuries as the yield fell sharply in reaction to that news. Remember that the lower wage rise equals less pressure on inflation, which is obviously good for bonds. Okay, last week, let's just have a quick review of what went on. Equities were flat to small up. The FTSE and the S&P were probably the better performing ones, up just over 1%, but unchanged on the DAX. Really, so not too much movement there. Currencies, well, despite Friday's late afternoon volatility, currencies ended last week flattish. The euro, yen, and the Aussie were pretty much flat on the week versus the dollar, whereas sterling actually managed to recover a little bit, about just over 1 cent on the week, I should say, up about 0.75%. Undoubtedly, the biggest move was in crude oil last week, especially Brent, which fell significantly. That fell $2.85 on the week. In percentage terms, that's over 5%. WTI, or the US crude benchmark, that fell less than that, $1.3, which is 2.7%. Nevertheless, Brent had actually fallen less a couple of weeks ago, so there's a bit of catching up, I guess you could say, from the Brent crude market. Negative factors continue to mount as it appears that the shale oil production in the US was less affected by the Saudi-inspired price collapse, plus this recent nuclear agreement with Iran suggests Iranian oil supplies are likely to increase significantly in the coming months, which is going to add to the current oversupply in the market. Of course, this nuclear deal still needs to be ratified by Congress in the US and then the sanctions lifted, but the belief is that that will happen. And so, in fact, Iranian news agency announced Monday morning that the Iranian oil company expects to be increasing or starting its exports significantly in November. So that's added further downward pressure to crude Monday morning. Let's get on to the data and events this week. As mentioned, it's non-farm payroll. That comes out on Friday. The number we're looking for the employment change is 224,000. Obviously, we can get revisions to the previous month, so that should be watched out for. The unemployment rate at 5.3% as well. That's the headline grabber, really. But if we do get data around this or slightly higher, I think it will increase the likelihood of a rate rise by the Federal Reserve in its September meeting. Other than that, we have the precursor to the non-farm employment from the Bureau of Labour Statistics. We have the private payroll company ADP that have their own reading on the non-farm employment change. 218,000 expecting. This number is quite a lot more volatile than the official statistics, and the correlation is not that clear, but it certainly should whet our appetite ahead of Friday's data. As I say, other than that, we have 3 interest rate decisions this week, none of which we're expecting any change in the rates, but just so we are aware of them, we've got the Reserve Bank of Australia meeting on Tuesday morning or Monday night, Tuesday morning. No change expected. They're maintaining the rate at 2%. We also have the Bank of Japan meeting this week. No change there. That's actually on Thursday evening, Friday morning. But the main one, as far as we're all concerned here in Europe, is the Bank of England's Monetary Policy Committee meeting. We're not expecting any change in rates from the Monetary Policy Committee, but it's notable that Mark Carney, the Governor of the Bank of England, decided to merge a number of releases. That's the Bank of England's quarterly inflation report and also the minutes from the previous MPC meeting. So not only have we got the official bank rate release, as it were, which is, as I say, we're expecting no change in rates there. We've also got the official votes, and it should be noted that 2 members of the Monetary Policy Committee are advocating an immediate rise in interest rates, something the market is expecting. So as we can see, the voting will be 207, to signifying to people who wanted an immediate rise in rates. A lot of manufacturing data out this week and non-manufacturing from both the US, data out on Monday afternoon, and the services sector referred to as non-manufacturing in the US. We've got manufacturing and service sector data in the UK, that's on Monday, and our services PMI on Wednesday. And we have the same in the Eurozone as well. So a lot of data out, too many to go into too much detail here. Safe to say that the Eurozone data could be slightly positive as the negative effects of the Greek crisis seem to be having less effect and are less relevant now, obviously. That's it. So the main event really being non-farm payroll data in the States is the main focus of the whole week. Thank you very much for listening. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.